all of these things, you need to know the whole picture. That will determine whether or not you should buy Tesla. So my default answer when somebody says, hey, Casey, should I buy blank? My answer is no. Welcome back to another video. Today we are going to be going over why stock picking won't make you rich. Yes, you heard that right. The guy who has the stock market channel is telling you that stock picking won't make you rich. And what I mean by that is that stock picking won't reliably make you rich. The reason for that is because of things like the efficient market hypothesis, things such as people who pick stocks, they tend to either incur fees, or they tend to make picks at the wrong times, or they tend to have incomplete information, or they tend to not be able to predict the future. Unless you're like me and you have a crystal ball that tells you where the market's gonna go, look, don't look at the futures indexes. Just message me on Instagram and I'll tell you exactly what the market is gonna do for the next 5 weeks, guys. All you have to do is buy my course and I will tell you where the market is going for the next 5 weeks as soon as I see it in my crystal ball. I'm just kidding, guys. You can't reliably predict what a stock is gonna do. People ask me all the time, Casey, is Tesla going to keep going up? Is Nikola going to keep going up? I cannot tell you that, but what I can tell you is what I'm willing to pay. That is what you should focus on. I actually have a video about the 13 steps that you should take before you go and buy a stock, and I'm going to put a card for that video above this. We're going to be recapping that video at the end because only 200 of you guys saw it out there. There's 3,000 subscribers now, and that's one of my first videos. Very old video, very cringe video, but we're gonna be rehashing that at the end. But first, we're gonna be going over the major determinants of wealth that are actual real determinants of wealth. So 3 things that I see a lot in poorer communities, poor individuals, is that they have this kind of casino mindset. Sometimes literally a casino mindset. They want to go to the casino because they think, like I remember hearing some people, I'm not going to name names because I don't want to, call anybody out that I know very personally, but they're like, oh, we're going to the casino, we're going to go get rich. And that's their mindset. They think, how we get rich is we go to the casino, we make a big score, we make a lot of money out of a little bit of money, and that's how we get to wealth. They're thinking something like, I had somebody come up to me and ask me, hey, I've got $3,000, should I buy into Tesla? And I'm thinking, well, I need to see your whole financial picture. Like, how much cash do you have? Is this your whole life savings? What are your earnings look like? Is this a significant amount of money to you? I mean, right now, Tesla stock price is about half of the money that you're thinking about investing. So is that good diversification? Is that a good strategy? Could you be diversifying into partial shares of Tesla? Could you be buying something else that's different? Is Tesla overpriced right now? What are you willing to pay for Tesla? And that's the ultimate question. What am I willing to pay? What is the most I'm willing to pay? And anything under that, I should be willing to pay as well. So if the stock price continues to drop, if I did my analysis correctly and I like the company and I want to own the company for the long term and I have a long time horizon, I have a high risk tolerance, depending on, when I'm going to retire, am I close to retirement? All of these things, you need to know the whole picture. That will determine whether or not you should buy Tesla. So my default answer when somebody says, hey, Casey, should I buy blank? My answer is no. So casino mentality, high returns on little money. And the last thing that I wanted to get into is the poor tax, as I call it, or the lottery. A lot of poor people play the lottery. Not a lot of rich people or people who come for money play the lottery, because that's not how rich people see building wealth. Rich people see building wealth as an activity where they increase their income, they decrease their expenditures, and they build wealth over time. They get rich slow, they don't get rich fast. Unless they start out rich, but that is not most millionaires. Most millionaires do not start out rich. So let's get into some of the biggest determinants of wealth. Number 1 is going to be being okay with being uncomfortable. Now, what do I mean by that? I mean, you have to be okay with working that job that maybe has a higher income, but maybe it's a little bit more uncomfortable. If people liked doing the thing that they're paying you to do, they probably wouldn't be paying you to do it. They probably just do it themselves. So sometimes when you're trying to go out there and make an income, sometimes getting those skills or doing that thing is going to be uncomfortable. Sometimes when you have some desire to buy something, not buying that thing is going to be uncomfortable. You have to be okay with being uncomfortable. With growth in any way, whether it be of your physical body or whether it be mentally, like studying or something, any growth requires some level of discomfort. You have to be okay with being discomfort to grow a bank account, to grow your body, muscular wise, not fat wise. You can be very comfortable and get fatter, but you have to be okay with being uncomfortable. Number 2 is your spending habits. So you can make as much money as you want to. You can look at Mike Tyson, for example. He made a ton of money, but then he also went bankrupt or was extremely broke. I'm not sure if it's exactly bankruptcy per se, but he went completely broke because he spent all of that money. Number 3 is income, or producing a lot of market value. So one thing that I always preach on this channel is that having a very high market value is very important to increasing your income. It's kind of a humbling thing to do, to say, I don't make that much money because I don't do anything that's very valuable to the marketplace. Being able to just identify yourself as the reason why you're not making that much money, or the value of your skills, it's the first step towards making a higher income. Once you do something that's more valuable, you will make more income. Number 4 is automation, or in other words, having an automated savings plan, having something that happens regardless of your intervention into it, something that's not actively done by you. For me, that's my 401k contributions. I've got those currently set at 30%, so I know that 30% of my gross income from my check from my job is going to go into that 401k. So that seems a little high, but soon we should be getting to the point of YouTube monetization. So it's not 30% of my total income, because I do have incomes outside of that job, and I'm kind of doing that to tax myself, to incentivize myself to do a little bit more YouTube. It's a little bit of a mind hack that I'm playing on myself. You know, if I'm not seeing very much reward from my job, I will subconsciously kind of be like, well, I need to go make this YouTube thing work, because that stuff doesn't automatically get filtered into my 401k. So it's kind of a little mind game I'm playing with myself. But anyways, number 5 is priorities. People that go on to be rich tend to prioritize freedom over things. So if you prioritize freedom over things, you will tend to keep your money, because the money gives you the freedom. The investments give you the income, the passive income that you need to have that freedom. And the last determinant of wealth is kind of a add-on to the last one, and is how do you value money? So one thing that I think is very important to my psyche as far as having a very high value of money and wanting to retain it is I see my money as my time and as my life energy. So seeing my money as my life energy, that means that whatever I'm making per hour at my job, I see that time and that money as interchangeable. So if somebody wants to take $75 from me and I make $25 an hour at my job, they're basically saying, I want 3 hours of your life. So that kind of structures my purchasing decision. So if I'm thinking about buying a $75 thing at my current level of earnings, now if I was making, let's say, $1,000 an hour, that $75 thing would be worth a lot less of my time. So maybe I would buy that thing. I'm much less likely to buy that thing if I'm making $25 an hour. And really, when it comes down to it, what is a transaction besides giving up one thing that you value less for something that you value more? So if you take that money and you equate it to your time, then you're basically saying, I value 3 hours of my life less than I value whatever you're trying to sell me. So if you're selling me something, I'm immediately doing that subconscious calculation of how much of my time am I giving across this counter. I don't even think of the money as money. I think of it as my time. I think of it as I'm handing over a piece of my life. Recently, for example, I just bought some Tesla short shorts. Those are about $75. Is that worth 3 hours of my time? Would I work 3 hours of my job to get those Tesla short shorts? I decided in my head, yes, I would. So I bought those. A lot of other things that are $75, I decide that that is not worth 3 hours of my time. There is no way I would work 3 hours of my time for, say, a really nice dinner or something like that costs $75. I don't care about it that much. I'm not at that point in my life, so they wouldn't get my money. So last thing that we're going to go over are the 13 things that you should do before you buy a stock. So if you skipped to the timestamp, then this is your part of the video. All right, part 2 of this video is the 13 things that you should do before you buy a stock. So you can either watch this last part of the video, or you can go watch the other video. The other video is about 10 minutes. I'm gonna try to get it done quicker here. We can get it done in like 3 or 4 minutes, but let's go ahead and get into those 13 things that you should do before you buy a stock. So number 1, do you fully understand this business? Do you understand how they make money? Do you understand how they plan to grow their income? Do you understand the risk factors of this business? Do you know this business well enough to answer these questions and many more questions before buying the stock? Buying on trends or someone else's recommendation or solely because you like their products is a recipe for disaster. Number 2, have you read the 10K or the 10Q? So basically these documents lay out everything about the stock. They lay out all the financials, all the plans for growth. They lay out where the companies came from, where the company's going. That almost sounded like I was about to say something about Cotton Eye Joe, but where do they come from? Where do they go? What's the management team? All of those things. It's going to tell you all about the company, where they're located, where they do business, all the information you could want. It's in the 10K, 10Q. Number 3, have you listened to the most recent conference calls? So the conference calls, they're basically going to tell you what their business did in the past quarter. They're going to tell you what they did in the last year. They're going to tell you where profitability came from, where it's headed, all those things. Number 4, do you know the risk factors for this business? Do you know who their competitors are? Do you know what could potentially tank them? Could a health crisis take them down? Could, not being able to pay their rent, is that a risk? What are the risk factors? Are they divesting some of their assets? Do you know what's going on in that business, basically? Number 5, make sure the company is profitable, and if they are not profitable, make sure that you limit your exposure to that company. Number 6, is the forward PE underneath the industry average. So if they are an industry leader, that's one thing. If they're, say, Amazon, which they're in the tech/e-commerce space, they're an industry leader, their PE is going to be above the industry average. But if they are, say, like a second grade stock or, third in their industry, are they selling below their industry average? So are they selling basically cheap for the industry at that particular time that you're going to buy the stock? So let's see. Number 7, has the company grown net income and revenues for the past 3 to 5 years? So if they have not been growing their income, you're not going to be able to grow your investment because the investment is valued based upon that growing stream of income, that growing stream of dividends, share buybacks, and just profits. So if the investment itself is not growing, then your money is not going to grow with it. If it's shrinking, your money is likely going to shrink. Number 8, do you expect the company to grow net incomes in the future? And if so, how? So that's something to read in the 10K and 10Q. Number 9, does this company have more in cash and investments than in debt? Is the company going to go insolvent, basically? Like, let's say that they have something like the COVID-19 situation where all money just stops. Could they pay off all their debt and still be able to, cash out the shareholders, get the shareholders some equity back? Are they on the verge of bankruptcy? That's what you need to know, because a lot of people bought into Hertz, and Hertz was a bankrupt company. They literally advertised that they were going bankrupt, and a bunch of Robinhood traders flocked into the stock. Almost done here. Number 10 is the management team. Do you know about the management team? It's good to go to past interviews by the management team, figure out what they've done in companies that they've been in the past, positions that they've been in the past. How did their companies do? For example, if you're going to invest into Tesla, it'd be good to see how PayPal was doing when Elon Musk was at the helm of PayPal. Number 11, does the company have a capital return program in the form of share buybacks or dividends? So this is basically going to be a sign of a mature company. This is going to be something that's going to indicate that they're going to give money back to the shareholders in the form of either buying the stock back or in the form of dividends. Number 12, in the video that I linked, I called it the knockout, and it's basically saying if you were knocked out for 5 years, would you be comfortable with the fact that you invested in this company at the beginning of those 5 years? Would you be comfortable holding this stock for 5 years? Do you know where this stock is going to be in 5 years? In the case of Nikola, nobody really knows that. So that's why I'm not going in on Nikola. I think that Tesla would be doing pretty well. That's why I bought Tesla shares. I think they'll be doing pretty well in 5 years. Whether they'll be doing as well as the current price reflects, who knows? That's why I'm going in on partial shares. I'm just nibbling off a little bit. I'm not buying entire shares of Tesla at these prices. And the last one, number 13, is are you willing to buy more of the stock if the stock goes down in price? So if the stock goes down in price, that essentially means that it's a better deal. You should be willing to buy more if you evaluated the company right if you said, this is what I'm willing to pay, anything under that, you should be also willing to pay, unless the company fundamentally goes downhill, and that's why the stock price crashes. So anyways, hopefully you guys did enjoy this video, get some value out of it. And yeah, anyways, what else do I usually say? Something about my links and self-promotion, and we're at 3,000 subscribers, 3,000. And yeah, see you guys in the next video. That was a weird outro.